Yes, Saranya, we are back again. So we'll start off now. Good. So hi friends. Welcome for the evening session for today. And today's topic will be the most important topic in CA. So in fact, I'll start with this note. The note is about a country which has accumulated a lot of nuclear power, but still it does not have food for its citizen. Reason for that ஏன் அப்படின்னு பார்த்தீங்கன்னா அவங்க வந்து எவ்வளோக்கு எவ்வளோ நியூக்ளியர் பவரில் இன்வெஸ்ட் பண்ணியிருக்காங்களோ அவ்வளோக்கு அவ்வளோ ஃபுட்டில் இன்வெஸ்ட் பண்ணாததுனால அவங்க சிட்டிசனுக்கு சாப்பாடே இல்லாமல் ஒரு ஒரு நிலைமையில இருக்காங்க. ஸோ தட் இஸ் அபவுட் த கண்ட்ரி. ஐ எம் நாட் நேமிங் இட். ஸோ வித் தட் நோட் we are starting with a topic called as AS-2, Accounting Standard 2 on Inventory. And today, the faculty for today's session will be Sharanya. So, to give an intro about Sharanya, so Sharanya is a practicing chartered accountant, and she has worked in MNCs and something related to finance. And also, out of a passion for learning and teaching, she is currently pursuing a diploma in IFRS from ACCA, which is in UK, a prime body. So, with that note, yes, Sharanya, the floor is all yours. So, yes.
Let me start it without making, because I don't want to waste this time in the Sunday. Okay. First of all, I wanted to tell what is accounting to the guys who are there. So accounting is a language. According to me, accounting is a language. Where accounting is a language, who's telling, like who is conveying. Business is conveying. As we all know, we have learned, and some of you have heard in your colleges, that there are 9 concepts in accounting. The first concept we learn is business entity concept. Whenever you start doing accounting, you have to think about the business entity concept. That is, owners are different from the business. Whenever you're accounting, you always have to be account from the perspective of business. That is, business is conveying to the stakeholders about its profitability, about its equity, about its liability. So we always should account from the business perspective. That is business entity concept. So this is the base important concept before you start doing start doing the accounts. Okay, let me start introducing about accounting standards now. Let me share my screen. Please let me know whether my screen is shared. Whether my screen is shared, Anish?
No, Sharanya, it's yet to be shared.
Whether my screen is shared?
Not yet. Yeah, I guess yes, Sharanya, it's shared now.
Okay. I'll start with the introduction to accounting standards. Yes. Before getting into accounting standards, this is the agenda for knowing the introduction to accounting standard. First, we'll go through the introduction about GAAP and accounting standard, and coverage of accounting standards, and benefits and limitation of accounting standard, and the process how it is applied in India, and applied in India, because international level we'll see detailed in our own class, and number of accounting standard and its applicability today in the introduction. Yeah. First, introduction. We have to know the term generally accepted accounting principles, what it is. It is in a common words, if we want to tell, it's a common practice what we are using. Like, see, it is a language. As I said, it is accounting is a language. Why GAAP and accounting standards has been introduced, I'll tell you. See, I will do accounting in my own way, and someone will do accounting in their own way, because we have lot of option to account. So if everyone are accounting in their own way, when the users of the financial statement can't understand it properly, So like everyone should tell a word in the same. If you are telling a name, it should be everyone should say tell the same name, then only you will understand what we are telling. So when everyone is accounting in the same way, then only people or users of the financial statements will understand what exactly what has happened. So that is why the GAAP and accounting standards has been introduced. So GAAP is nothing but, you will understand in the term itself, generally accounting accepted accounting principles. So generally accepted accounting principles refers to a common set of accepted accounting principles, standards and procedures that business reporting entity must follow when it prepares and presents its financial statement. I think the statement is very clear. And GAAP is a common recording and reporting information. That's why that's how GAAP is. And what is accounting standard? uh, Accounting standard is called as Indian GAAP. That is, in India we commonly represent and present and measure and value in the way what our accounting standards has given us. Accounting standards is just a guidance for everyone how to account. So this is the introduction about GAAP and accounting standards. Then we'll move on to why accounting standards. So yeah, this is what I actually explained. Accounting standards reduce the accounting alternatives in the preparation of financial statement within the bounds of rationality, and thereby ensuring comparability of financial statements of different enterprises. Yeah, what is why accounting standards is like, I am preparing some financial statements, and some other person is preparing some financial statement. It ensures that when everyone is doing the same, like similar accounting practices, it is easy to compare. And also it is easy to read that. As I said, this is why we need an accounting standard. So in accounting standard we have various guidance how to um, in in accounting standard we have various guidance, that is how to recognize a small transaction. Like if it is sale, the in sale there is a sale, there is a purchase, there is assets, there is inventories, everything are the components of financial statements. So we have to understand there is a common set of principle for everything: when to account, how to account, how to value, and how to disclose. These are the guidance given in accounting standards. So the coverage of accounting standards is nothing but recognition, how to recognize a transaction and event. That is, for example, if there is a sale, at what point of time we have to recognize, how much we have to recognize, and what are the how, like whether like how to, like same, yeah, sorry. So these are the recognition thing. Measurement, how to value, for example, uh, our inventories, how much to value, how to account, what is the value to account. These are comes under the measurement. And presentation is nothing but how to present. For example, there is a depreciation, whether we have to reduce from the amount of fixed assets and show, or whether we have to show as if the whole gross amount, or we have to show net amount, like that. That is the presentation. So our accounting standards gives a guidance on presentation also. And disclosure requirements, sometimes some items can't be disclosed in present, can't be presented in financial statement, but it will be very important for the users of financial statement to be known. Like for example, if there is a contingent liability which is not currently payable, but it may cause future impact. Okay, but it is not currently payable. So so the owners or someone who is management who can hide it. So this is where the coverage of accounting standard comes, and they wanted mandatorily some portion to be um, disclosed. So there are a lot of disclosure requirements which has to be disclosed in the financial statement. Those are covered under accounting standards. We'll come to the part of benefits and limitations. Let's start with benefits. What are the benefits of accounting standards? We have various industries, and also we have various transactions and all that in the business. We are talking about big business and large entities. We have lot of branches, we have lot of transactions which can't be if they have given a one set of guidance or set of accounting treatment, it won't be enough, because there will be lot of scenarios which will be different in uh, different. So we need a many alternative options. So the accounting standards have given alternative options too. It is not like restricted to one option. So they have given lot of alternative option, industry based, entity based. When we check into applicability, we will actually know what are the various options, what are the where, how they have divided, how they have guided each of the entity or industry wise or corporate non-corporate wise. They have um, advised to follow it. So these are the so the benefits of accounting standard is we have various reasonable options. Yeah. Okay, second one, requirements of additional disclosure. Sometimes our statute do not implement, I mean, do not force us to give more data. Like statute will be every statute, like for example, if you have a partnership act, the partnership act will not cover everything to disclose. There will be a limitation in the statute for the requirement of disclosing. So here accounting standard they extended, and they have given lot more information mandatorily to be disclosed. In this way, the users of financial statement will clearly understand the require clearly understand what is happening in the business. And that's how the additional disclosures have been added. And the third one, comparability of financial statements. Yeah, as I said earlier, when everyone is following the accounting standards, the comparability will be very easy. Like I can compare with the next entity, so that I can improve my sale, I can improve my strategies, I can improve my I can so the competition also will be very healthy. And also we can compare our own results from last years to this year, when the policies and when the accounting and when the application is very uniform, it is very easy to compare. Otherwise we have to do lot of adjustments and working to compare. So in this way, comparability, when we are using accounting standard, the comparability is very easy. So that's how it is. So actually nowadays it's we have brought IFRS and Ind AS 2 for comparing international level, global level. So now we don't want to get into the all those things, because it's just an introduction of accounting standards. In our detailed class, we'll see about the detailed version of in how the convergence of Ind AS about in IFRS, and also the detailed accounting standards applicability. Yeah. The limitation, the one big limitation in accounting standard, what everyone feels is the statute overrules the accounting standards. That is, when you have something in the statute which are contradictory to the accounting standards, always the statute prevails. That is, when government passes some rule or something that this should not be disclosed, and accounting standards cannot enforce something which should be disclosed, when it is contradictory, the statute always prevails. This is what the limitation is. And sometimes even there are lot of standards, maybe in standards there are lot of alternative options, but still people are feeling that is too rigid and inflexible manner. So they feel there should be lot more option, and the options are not still enough. These are the limitations of accounting standards. Okay. Then we'll see how this accounting standards have been formed, how it has happened, all it started, and how it is applied now. Okay. So we have a body called Accounting Standard Board. It has been constituted in 1990s 1977 by our own mother body, ICAI. So accounting standard board is a major body which prepares, which gives a draft, which finalizes. There is a standard setting process which ASB involves, and gives us a final draft of final accounting standards. So our ICA helps with ASB to do all those things. So that's how it happens. And while applying it for companies, we have companies which is covered under Companies Act. The statute for companies are Companies Act. So MCA should notify for companies the accounting standards applicability. For example, I'll tell you, there are accounting standards. Now how will you apply, they will implement to corporates, partnership firms, and other trust or something, all those entities, how people will implement. So this is how they will implement. For non corporate entities, ICAI will notify which are the accounting standards are applicable to non corporate entities, and MCA will notify with the consultation with NFRA that what are the accounting standards applicable to companies. So this is how it is applied. And also, when accounting standard, we have lot of issues like there are many industries will be there, and they will have lot of doubts, how those doubts will be solved. So there is the accounting standard interpretations where accounting standard board itself will release, and in that interpretation, like income tax case laws, indirect tax case laws, we will have an clarification how it is applied, what will be prevail when there is a conflict, and how to handle it. All that accounting standard interpretations will give you a guidance. And for some of the interpretation, now they have notified to combine with accounting standard itself. So in accounting standard, in explanation para, we will understand everything, like how the issues will be solved, what are the contradictory things, all that. And yeah, as I think I have discussed about the applicability. And in our CA Inter, the third chapter, part 1, is deals with applicability of accounting standard, which they have given very in a detailed manner. So I think today it won't be enough for us to see all those things. So applicability of accounting standard itself will require 1 hour or so, which I'll take in my regular class. So we'll see that. So applicability is very important. I think you should understand what is accounting standard. See, this is not a mark scoring area, but still you have to understand the basics very well before going into the deeper concepts. Without knowing where to apply, how to apply, and when to apply, there is no use in learning accounting standard. Though it is not a place where they ask more questions, but the applicability is very important as you go next stage. So this is what about applicability of accounting standard. So I'll go to the next topic, that is valuation of inventories. Yeah, we'll start up with the valuation of inventories. I have to show you a small thing. Okay, this is profit and loss account. So we will have credit side and debit side. So debit side, we will have purchase opening stock purchases, and credit side we will have sale, and we will have closing stock. Same way. So this is debit and this is credit. So in balance sheet, assets. So we will have a capital other liability, loans, other liabilities. That is current liabilities. I mention it as other liabilities. Assets, here we will have fixed assets. Now we call it as PPE. Second one, there are various intangible assets, so on. We'll look into stock, closing stock. So this is the area we are going to see how we gonna uh, value closing stock, which comes here and here. What will be the value and what should be the value? What are the cost formulas we should take, how to recognize, how to measure, what all the items to be disclosed in notes to accounts. Notes. So you all know there are we have the components of financial statements. We have profit and loss account, we have balance sheet, we have notes to accounts, and we have cash flow statements. So disclosures all will be gone to the notes portion. So we'll come to the valuation of inventory part. So today's agenda is, I can't take you in an explanation, I mean brief, I'm taking only in a brief way. The explained way will be taken in our uh, classes. So I'll take you through scope. What is the scope of inventory, I mean valuation of inventories? Definition, what are excluded from the valuation of inventory and how to measure, and what are the components of cost, and what are the components of net realizable value, and what are the formulas, and what disclosures we have to do. Okay, we'll go to the scope. So as I tell, as I earlier mentioned, shown you in the Excel, it is a value. It is a value of inventory. It should be what should be carried on financial statements before recognizing revenue. That is, before we sell the stock, it will be in closing stock, right? Before we sell it, it will be in our closing stock, and in current assets, it will be in a stock inventories. So before selling it, how to value the inventories is the scope of the standards. And they have also given how to value net realizable value. That is, I'll explain later. I'll explain in the upcoming slides. Okay. What is an inventory definition? Okay. Inventory, as per accounting standard 2, they are telling inventory is an asset held for sale in an ordinary course of business, or in the process or production of sale, or for consumption in the production of goods or services for sale, including maintenance of supplies and consumables other than machinery spares, servicing equipments, and standby equipment, meeting the definition of PPE. This is what the definition they have given. That is, held for sale in ordinary course of business. What it is? It's just a closing stock. When the product, for example, when you are in a manufacturing industry, we will get in raw material, and we will process it, and we will put in stock. That is finished goods. A good is already processed and ready for sale is your finished goods. And what is work in the process, and the second line, in the process of production of such sale, that is work in process. We got a product, that is we got a raw material, and it is in the mid stage of becoming finished goods, but not yet being a finished goods. Still it is asset for the company, because we will make it as a finished goods and we will sell it. So that is also comes under the scope of inventory. Third one, we have got it but still not processed it, and still not come to the made to the stage of finished goods, that we call as raw materials. So the inventories include raw materials, work in progress, and also finished goods. So they have mentioned that this do not include some property, plant and equipment. I'll tell you in detail when we study property, plant and equipment. Then, what are the exclusion in this accounting standard 2? What will not include? That is, these are not explained in AS2. When you are facing crossing these scenarios, you should not refer AS2. These should be referred in some other standards. That is, Work in progress arising in construction contracts. What is construction contract is, some people, some industries like they will construct buildings. They have a separate accounting standards, separate accounting standard how to value work in progress, so that should not be covered under AS-2. And second one, uh, which the service provider who's providing service whose work in progress should not be referred for AS-2. Third one, shares and debentures of financial instruments. Shares, debentures, and financial instruments held as stock in trade. That is, some people will buy shares, buy debentures, and sell it. So those financial instruments will be kept as inventories. That should not be covered, and that should not be referred to AS2. When you're handling those transactions, you should not refer AS2. Third, fourth, that is producers of inventories of livestock, that is agriculture products like livestock, cow, goat, and hen, all that, and forest products, mineral oils, all that should was not covered under AS2, because those are the things which will always accounted in net realizable value, which is not covered under AS2. The next one, this should be like, even when you're sleeping, if someone asks, this should be told, because this is the major concept, and this will be seen in every balance sheet and every entity when you cross it. Okay, inventory should be valued at lower of cost or net realizable value, whichever is lower. That is, in balance sheet, when you're accounting inventories, it should be of cost or net realizable value, whichever is lower. For example, we purchase, example, we purchase a stock raw material, that is uh, some cotton we are purchasing for 100 rupees purchase cost. We convert it for giving labor, other overheads, and we are converting cost is 20. So, and the cost now is, so 120 is the cost, which should, so 120 is the cost. So what is net realizable value? It is, net realizable value is a value which we can sell it. What will be the amount we can sell it in market? So this, for example, we are purchasing cotton and converting into a dress. Okay, dress cost is, that is inventory cost is 120. And net realizable value, there is a sudden some earthquake or some fire accident has been happened, and this dress has been damaged. So now there is no people to get this dress. So the net realizable value become 10, because no one is going to buy it. So you don't have option than selling it for 10 rupees. So now the net realizable value is 10. So now we, what will be the cost of stock? It should be less, lower of cost or net realizable value, whichever is lower. So your stock should be 10. This is how it is. This is the measurement formula. So we'll go to next slide. What are the components of cost? Okay, as I said, if it is a manufacturer, if it is a retail agency, for example, someone is purchasing shirt and selling it. I am a trader, so in that case, I will have only. I am a retail person, so I will not have any conversion cost. My cost will be cost of purchase alone. So my cost will be cost of purchase, and there are more components also, like there are manufacturing industries and other industries where we have to get the raw material, do a process, and sell it. There we can see cost of conversion, that is labor, material, other overheads. And there are a lot of I mean suggestions have been given in accounting standard how to take overheads, how to allocate overheads for the cost of conversion, which we will see in detailed class. And other cost means which we like a freight while getting a while we are purchasing cotton. We may send a lorry, or we may incur some freight charges or other charges like purchase we may import duties, export duties, and GST, all that we may incur, and that is also inclusive of cost. So so other cost, like when we are purchasing an inventory, the cost incurred to bringing the inventories to the present location and condition, all always also we can include in cost. For example, freight and that duties and taxes we can include in the components of cost. So these are the components of cost. So while we calculate component cost value, we have to consider all this. What is the cost? What is the cost we have purchased? What is the cost we have incurred for converting the raw material into finished goods? And what are the other cost made for bringing the inventory to the present location and condition? These are the components of cost. We have joint cost and all that, which we will cover in a detailed class. Now I don't think that that will be very heavy for the demo class, so we'll see that. For inventories, so this is just a picture how, okay, with how to show raw material, I mean raw material, w and work in progress, and net realize, I mean finished goods. Okay, when we go to stock, we'll classify as stock includes for example, raw material, work in progress, and finished goods. So, so what is the cost? How to account raw materials? It is cost, otherwise a replacement cost. The rule is cost or net realizable value, whichever is lower. So raw material, we have a condition, so that we will cover in a detailed class. Now we'll just see that raw material, it is just purchase cost or replacement cost, whichever is lower. For WIP, the cost includes cost of purchase, conversion cost, or other cost. For finished goods, so the lower of cost or net realizable value for WIP. WIP cost includes cost of purchase, cost of conversion, and other cost. And finished goods also lower of cost or net realizable value. So here comes cost or replacement cost. So cost or net realizable value. Finished goods also cost or net realizable value, whichever is lower. We'll go to next slide. That is components of net realizable value. How to value net realizable value? For example, as I said in my earlier example, someone is purchasing cotton, they're converting, and the dress cost is 120. Suddenly there is a fire accident in the godown or something, so the dress all damaged. Now we can sell it for 20 rupees after making some cost to the dress, that is maybe stitching it or dyeing again to make it all right. So that cost is 10 rupees. So we have to minus selling cost minus cost of completion. That is what is the cost we make to to make the product for ready to sell. How, what are the cost we gonna incur to make the product to ready to sell or to sell that? So we are incurring 10 rupees. So this should be included. So the net realizable value is 20 minus 10. So our net realizable value will be 10. Third one, we have lot of cost formula. So for example, now for example, we have purchased 100 rupees a cotton, we have converted to 20, and the dress is 120. This is per unit. We got it on January. We have made it on January. And February, we have purchased. Raw materials will not say raw materials or conversion cost will not be same all point of time. When we are getting it for the February, the purchase cost has become 85. The conversion cost has become 35. So the cost of dress has become 85 plus 35 is 120. Sorry, this should not be the figure. Maybe 40. So 125. Now the cost has been increased for per unit. So while selling it, so the now we have two units, which one has been sold in the current year. One has been sold in the current year, and one more unit is there pending, without being sold. So this one unit should be come in stock. So what will be the value we will take as cost? 120 or 125? Let's take net realizable value will be 135. So it is more than cost. So lower of cost is 120 or 125. So what we will decide, the unit sold has been on April. So will you consider that this unit has been sold or this unit has been sold? There will be lot of production and sales. So we cannot identify which unit has been produced and which has been sold, and we cannot allocate properly to each unit what has been purchased and how much is the conversion cost, and how can which unit has been sold. So now we have one unit. Should we take 120 or 125? There our accounting standard comes to clarify. We can take first in first out method, that is FIFO. We should consider this 120 has been sold, and now we have is 125. So we have to consider this stock cost as 125, that is cost or net realizable value, whichever is lower. Or we can go to weighted average cost formula. So we have we have weighted average cost formula, which I'll tell in detailed class, because we are running out of time. So we have to take a cost formula which will be more fairest possible approximation. We have to choose a formula which is very fairest. We will see this how to choose an accounting policy in AS-1, which we will see in detailed class. How to choose an accounting policy, what are the suggestions what are the suggestions accounting standard 1 has given in disclosure of accounting policies and selection of accounting policies, we will see in AS-1. Then I think you can understand this very well. So what all to be disclosed after valuing it? What all should be disclosed in notes? Okay, what all to be disclosed in notes or in financials? So we should disclose what are the accounting policies has been adopted while measuring the inventories and the cost formula, that is whether we have used FIFO or weighted average, or how did we value adopted measuring inventories, what are the costs involved, all that we have to disclose. Second, we have to classify each, that is what is the amount of raw material, what is the amount of work in progress available, what is the finished goods figure, what are the stores and spares available, loose tools available, everything we have to classify. So These are the classification disclosures we have to do. Okay, thank you very much, and I think we will we will close it for today, and I will meet you all in the main class. Thank you.
So thank you so much, Sharanya, for a wonderful presentation. And
Thank you. Thank you.
yes, and it
Thank you so much.
got me back to the intermediate memory of going back to what is AS2. I've not
Thank
been.
you. Thank you so much.
Yeah, it has equally
Okay.
helped. Yes.
Thank you
So
so much.
yes, friends. So
Okay.
thank you so
Okay.
much, everyone,
Okay.
for
Okay.
being.
Thank you. Yeah. Thank you all for listening and investing your time on Sunday. I'm very grateful, and thank you for everyone who are watching.
Yes, friends.
Okay, Anish.
Thank you
We'll
so
take
much.
a leave. Thank you. Thank you very much. Bye bye.
Bye.